Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, in the equity markets, the IPO market is something that has garnered a lot of attention recently, not least of which because a few eye-watering valuations have been proposed. And they've found buyers. In fact, some have gone so far as to say that you might need to check your glasses. But then be that as it may, the question is, if you are looking to invest in a company, what should the approach be? And if you are subscribing to these IPOs, what should your thought process be? Because you may not necessarily have all of the information that other people do, or maybe you're not spending enough time looking at that information. This is going to be an attempt to tell you what to look at, because there's a treasure trove of information available out there. Sameer Dalal of Natvarlal and Sons Stockbrokers is joining me now. He's a regular on the markets leg of the content that we bring you through the day. Sameer, thanks so much for taking the time. Let me ask you this. First of all, IPOs seemingly in India and everywhere in the world, but particularly in India, go through seasonality or cycles. Is that true? And what have you witnessed over the last many years?
Yeah, Alex. So thanks for having me on the show. And you're absolutely right. There is some amount of seasonality and cyclicality when it comes to IPOs, because IPOs generally come out when the markets are hot. And the reason for that is that the promoters then get good value, or the selling shareholders get good value for the stock that is being sold. Now, generally, IPOs are good for companies because it gives them capital to grow. But you know what's happening in the current situation is it's not a lot of growth capital that's being raised, but it's more of selling existing shareholders. Because in India now, the private equity market has become so big that a lot of these companies are getting their growth capital from private equity. And then what's happening is we are getting to buy these much later when a lot of the growth is captured already by these private equity investors. So I think that is something that is very important that we should look at. Is something that who is the seller? Why are they selling? Is the money going to the company for growth? Is it going for debt repayment? Is it going for just an exit of a promoter or existing shareholder? All of those things need to be looked at, and that is why I think there is something that we need to look at in IPOs in more detail than what we do look at, and the cyclicality will obviously be there given the fact that the markets are hot right now.
Okay, that's fair. And you've talked about a few things that I want to discuss over the course of this conversation. But Sameer, just to draw a parallel that I think a lot of people will understand, would you say that it's kind of like a sugar cane that is going through the grinder, and when you're at the IPO level as a retail shareholder, what you're getting is perhaps the third run of the cane that has gone through the grinder? Would that be an apt analogy to make? You're not getting the fresh juice.
Oh, absolutely. I think that's exactly what I discussed, when I said the PE guys put in the money up front, right? Now, the question is, are you getting it through the third grinder? Or are you getting it through the first grinder? That is up for debate based on individual companies. You can't just use a single brush and paint all IPOs alike. But largely, yes, that is what we are getting at this point of time. Also, what we are getting is we're getting this crushed cane at a price of, let's say, full price of cane. So, it kind of leaves eventually not a sweet, but a sour taste at, maybe going down the line. So that is something that we do need to look at. But yes, definitely, I agree with your point that we are getting something that has been squeezed out to some extent. But like I said, I can't say third time.
Okay. So one of the reasons why I wanted to have this conversation is because there was this entire debate about the Lenskart IPO. And as we're doing this conversation, we still don't know what the listing price is going to be. Who knows? The grey market premium or the suggestions are that it might just list at a premium. But the question is, are you looking at this from the right lens, Sameer? Because these new age companies, because of the times that we're living in, are being pressured to show a profit. And that's what Lenskart did. Though it did not show that profit with organic activity. It sold mutual fund units, and there was a fixed deposit that was matured, and that resulted in the profit. And so as soon as there was a profit, Samir, people started using that as as a metric to judge them, to say the price to earnings is exorbitant. But then the argument that was made is that why don't you look at the revenue and use the price as a multiple of revenue? And if you do that, then it's not as expensive as certain other IPOs. How do you judge valuation?
Okay, so let's take Lenskart since we are discussing that. And if I had to just value every company on price to revenue, then the opportunity that would turn up in the market for me to invest in would be far more than what Lenskart stands to offer, right? There are companies that have, I'll just give you an example. Dixon is trading at, their net margins are 2.5% net profit margins. So if I were to just purely value him on top line and top line growth, then I think Dixon could probably be a multiplier for here. So that's not the answer to the question that people are saying that how should we value this company. So there are a couple of metrics that I would like to look at when let's talk about Lenskart now that we look at. So top line growth is one of them. Top line growth is coming. Why? Because he's constantly increasing his reach. He's pricing better than a lot of the existing mom and pop stores and stealing some of their business. The market is expanding, yes. But at the moment, the question you got to look at is what is the market expanding at and what you're taking away from, I'll not say unorganized space, but mom and pop stores. Yeah, mom and pop stores are standing to be losers in this bargain. So can you continue this kind of growth endlessly? And even if you continue this growth, at some point, you've got to start upping your prices to be able to make money. Now, I like to say two factors that I look at in any company, and forget IPO. Across the board, every company that is there listed should have two parameters that everyone looks at. One, obviously, is growth. How much is the market opportunity and what you can do? But second is the ROE, the return on equity. If I am putting 200 crores to work or 500 crores to work or 1,000 crores to work, what am I getting back at the end of the day in that? Today, if someone tells me invest 1,000 crores and I can give you 6% return on that, would you go out and you have to take high risk for that? Would you go out and do that? Probably not, right? So what changes for a company like a Lenskart if he's not able to deliver profitability and he's not able to say that, look, 2 years from today, I will say I will up my pricing so my EBITDAs will improve and my net profit will increase. Now, if you're going to do that and you value him 2 years down, at that point, what ROE will he generate at those higher price points and what will be his PE multiple at that point? So both these factors you got to look at. And I don't think he's going to be able to deliver us anything significant. Now, if you just want to keep valuing him on sales, I mean, I believe sales is for vanity and profit is for sanity. So if you want to continue on vanity, go for it.
That's a good line. That's a good line. And at 6%, you might as well put it in a fixed deposit, even though the taxation is not going to be as lucrative as the equity market is. But having said that, let's come to the brass tacks of it, Samir, therefore. The other factor to note is when you're going for an IPO, a lot of people go in for that listing pop, which has been harder to come by in the recent past because of the sugarcane analogy that we had. There's not enough juice left. And so from that perspective, you should be willing to hold it for years. But the point is that when you participate in these IPOs, because they're so overbid, you get a very small slice. So is it worth applying for an IPO in the first place? Or should you just wait for an opportunity to purchase these companies down the line whenever the opportunity presents itself?
So, Alex, I would like to say I prefer the second strategy where we can buy it at a better price, knowing full well what we're doing and not working on a lottery system kind of thing. But sometimes you may not get that same opportunity again. I'm not saying you will not, but you may not. Now, I'll give you, it's still early days, but NSDL, the IPO was at 800 rupees. This is a duopoly business, CDSL, NSDL. The stock is at about 1,120. Now, I would like to say I'd love to buy this stock at 800 rupees or even below, but I'm not sure I may get that opportunity again. So, like I said, you can't paint everything with a single brush. If there are certain companies which you think have great long-term growth, which are difficult to come by, which you may not even in a market fall, you may not see too much erosion in the stock price because the operating leverages for these companies are very strong. The ROEs are exceptional. Then you go out and make the investment during the IPO time and hope for the allotment. But in general speaking, I think 90% of the IPOs, you could probably follow the second strategy where you wait for a market fall. Look, every few years you have a 10 to 15% correction, and every 7 years you have a 40% correction if you go back into history and see. So over a period of time, identify which stocks you want, wait for those corrections, you will get them, and then that's when you go ahead and buy. So I prefer the second strategy, Alex.
A quick question on ROE, since that's one of the key metrics that you've pointed to. And of course, again, here, there is no one single answer to this. It would depend on the industry and the company. But what would you be comfortable with? And if you can give us broad ranges for, say, a manufacturing company or a commodities company or an IT company or a services company.
So ideally, a 15% ROE would be something ideally that I would say is something I would like, because that means you're getting twice the return against putting your money in an FD, right? So 2x of that, 2x of your risk-free is a very good return. If you are able to generate ahead of that, it's exceptional. Now, ROE to me is something I use to determine what price to earning multiple or price to book value a stock should be assigned. Because the higher the ROE that you can generate, it means that your capital use is fantastic, right? Now, I'm not saying everything can be like Lever gets a ROE of over 100%. And the reason is they don't do a lot of their own manufacturing. A lot of it is contract manufacturing. So they've not put in as much equity or capital, and they keep paying it out, and they're making great amount of profit. So you don't assume something like that to trade at 100 times earnings and stuff like that. But yes, should these stocks trade at a premium to others? Absolutely, they should. And for me, 15% is good, 20% is excellent. If somebody is about 25%, now there are companies, you give them a slightly higher value, and you assume that these higher valuation multiples could sustain as long as the entry barriers are very strong. Now, in the simple case of what we discussed, NSDL, which came for an IPO recently, entry barriers are very high. ROEs are excellent. This is a counter that one should stay invested in for the next 10 years. I think this could be a multi-bagger even from today. Even though the juice has been squeezed out, I think there's still a lot of juice left in that counter. I think the equity cult in India is only beginning. If you also have your dematerialization of insurance policies,
Sure.
this
Yeah.
is going to be huge upside. So everything has to be looked at individually.
Sure. Let's round this conversation off with a rapid fire. You're used to this, Samir. You know me. I like this segment, right? So I'll toss a few questions at you, and hopefully this will be beneficial to my viewers. And I'm just rambling on, right? So, in your opinion, the ideal number of stocks in a portfolio?
25.
The ideal allocation to each of these stocks, maximum?
At time of investment, 4%, but then if the stock does well, it can move up, but I would not like it to cross 10 to 15%.
Stop loss or no stop loss?
So fundamentals doesn't determine stop loss, but if the fundamentals change, exit at a loss.
Okay. How often should you churn your portfolio?
When you find a better idea there, which can generate better longer term returns than what you're existingly holding.
Okay. Loss-making entity but tremendous revenue growth, is that a deal breaker or an opportunity?
Again, needs to be looked at from the point of how much they can grow and how soon they can turn profitable. So I like QSR restaurants, QSR companies. I think they are not making too much money, but the opportunity ahead is so great, and the profitability that can come is so great. So I would say yes, you look at it, but you look at how long it will take to turn profit.
Okay. All right. Well, thanks so much, Samir, for taking the time. It's been a pleasure having you on this show.
Thank you very much, Alex.
All right, there you go. So that should give you some sense of how to approach the primary market. And as Samir pointed out, the opportunity will always be available to you in the secondary market if you miss the bus when the IPO is ongoing. And that might actually be a good thing for you.